Good evening, everybody. Please continue to enjoy your salads. For those of you who I did not meet, my name is Jason MacGregor. I'm one of the owners of Minich MacGregor Wealth Management. We're a registered investment advisory firm here in Saratoga Springs, and it's not just me. It's an entire team of us. Many of you spoke to Drew. Drew's in the back. And he's one of our financial advisors, soon to be a certified financial planner, studying to get his CFP as a planner. Our bios are on the website, so I won't bore you going through everybody's roles and responsibilities. But if you're curious, that's Minich. We've been working together for 25 years. We always have a little competition between the two of us, who's the smarter of the two of us. But this time of year, I always lose that conversation because he's based out of St. Augustine, Florida. So this time of year, it's clearly Jim is the brighter of the two of us. Not that Saratoga is a bad place to be. It's actually a great place to be. Did anyone not get a handout? Okay, good to hear. So pretty straightforward. Give you a quick lay of the land. I'm going to do a brief introduction for a couple minutes as you enjoy your salads. And then around 6:35 or so, the entrees will come out. I'll take a break from talking so you can enjoy your meals. And then around 7:55 or 6:55 or around when dinner's over, I'll give the bulk of the presentation. Usually I speak for 45 to 55 minutes, depending on the number of questions and where the conversation goes. We've been hosting seminars, dinners like this for many, many years. However, this is only our third one since COVID hit. We took a break for 3 years. So we just started back up a few weeks ago. It is great to be back. Great to be back at Jacob and Anthony's. They do a great job with the service. Good dinners. I've had, I don't think I've had the vegetarian, but I think I've tried all the other dinners, and they do a great job. Definitely known for their steaks, if that's your thing. We usually get a mixture of people coming out to our dinners. They are, whether it's existing clients, prospective clients who are kind of individuals who are kicking the tires to see who we are and what we do, just kind of scratch the surface there. Or we also get the DIYers looking to hear what the professionals have to say and our thoughts on the current market and or distribution strategies, just gleaning some information from us as the professionals. Not going to ask too much of anybody here. Maybe I'll ask a few questions. Participation is always great. If you want to participate, ask some questions. I will say there's one thing in your package, which I don't have. It's not much of a package. It's 3 pieces of paper. One for notes, a little bit of information. At the very back, the third page, there is a feedback form. It's the only thing I'll ask before you leave is you fill one of those out per couple or one for each of you. That's your prerogative. We do these workshops on a monthly basis. We always take your feedback sincerely. We do a little debriefing the next day and say, hey, Jason, what can we do? My team says, hey, what can you do better? Let's look at the feedback. And we do take that to heart. If what I say tonight piques your interest and you want to have a consultation, you do have the opportunity to ask for that at the bottom. And believe it or not, I was asked by the IRS once why I'm spending so much at restaurants. Am I there with my friends? Or what's going on? And I needed to show that I was not just taking my friends out for dinner and that we had these to support our business endeavor. So it serves a dual purpose, but that is a real thing. So if you would just take a few minutes before you leave and complete that, that would be very, very appreciated. Although everyone is unique, and I know most of you probably don't know each other, there's some common themes that we hear regularly from our clients and prospective clients, and I'm going to touch upon a handful of those. I do have the invitation that you were sent, and my goal is to be diligent about touching upon all of those topics. While you're having dinner, I'm going to come around to each table and ask you if there's something specific that you're hoping to learn tonight. If I can incorporate into my remarks, I will. If it's outside the scope, I'll also tell you that also, and maybe we can have a side conversation or a conversation at a different point here. There are a handful of areas that we specialize in. One is portfolio management. We do the investing for our clients, or most of our clients ask us to do that. That's not the main focus of tonight. Our main focus tonight is the financial planning side of things. You've all heard of the Secure Act 2.0 that got passed. That legislation got passed on December 29th of last year. A lot of things in there. It directly impacts retirees and those about to retire. So a lot of things to go over there. We are on our team. We have Social Security specialists, how to apply or when to apply, with the various strategies as far as how to apply for, and when to apply for Social Security. Distribution strategies. You've probably accumulated various buckets of money, and whether you're retired or not, you're thinking about how to distribute those monies back to you efficiently. Very, very, probably the number one question, or probably the thing that we talk to our clients the most and most frequently. Estate planning. We're not lawyers. Technically, Minich is a lawyer. He doesn't practice law, but we talk to our clients about estate planning and tax planning. Integral part of wealth management. We have a fiduciary responsibility to make sure that our clients' beneficiaries are up to date, they're accurate. We'll talk to you about trusts, Medicaid avoidance, protecting the money from the grave, so to speak, or controlling the money from the grave. And then lastly, Medicare planning. If you're about to turn 65 years old, it's a big decision to have, and then it's something you can have open enrollment every fall. Thereafter, as far as are you in the right plan, and it's usually not something that you can set and forget, but you can. But plans change, and it makes sense to revisit that from time to time because the costs and the features and benefits all change. By a quick show of hands, how many people are already retired? 2, 4, 6. Okay, so majority. Okay, not everybody, but majority tonight. It varies. It's usually right. Sometimes it's 50-50. Tonight definitely skews more towards retirement. Okay, that's good to know. I think in general, I'll keep my comments until I'll wait here for a few more minutes until the entrees come out so you can enjoy that. But if you have more questions, catch me as I walk around. Know that we've been doing this for. Well, actually, this will be my 30th year of providing advice to individuals. I started when I was 14, so it's you can do the math. I do have that. Minich's been doing it 6 years longer than I, so I guess that's 36 years for Minich. We're very proud of our systems, our technology, and our team. We do have a very defined roles, whether it's Drew and Corey as financial planners, Mark more so the relationship manager. I'm one of the lead portfolio managers. We make our decisions as a team on the investment side of things, with some support people in the background that make it all work. So we are very, very proud of the people. And Minich MacGregor Wealth Management has existed as an entity since 2009. Jim and I worked at Smith Barney. It was lots of different names. Shearson, we're dating ourselves now into the 80s and 90s, but Shearson Lehman Brothers, Salomon Smith Barney, lots of different names. But we left there in 2009 as Wall Street was melting down, and it was not a great time to be working for those big Wall Street firms. There's definitely some pros and cons. Not going to say anything disparaging because they're great firms, but it wasn't for us, and that's when we went independent, and we are completely independent. We're fiduciaries, and I'll say that as you're talking to different investment firms, ask some questions about how they're compensated. Are they fiduciaries? Are they owned by another entity? These are the questions that as you're looking and thinking about are the differentiators. And so again, neither right nor wrong. If you're a firm that's owned by, a big firm, that's fine. We just choose not to be. We like that independence and that ability to just do best by our clients without having any extra secondary influence breathing down our necks, so to speak. So enjoy dinners. They should be out, excuse me, the next 10, 15 minutes, and I'll be back up here in about half an hour. Enjoy. going to jump right into things here. And we're going to start with the financial planning aspect of things. And in a perfect world, life would be a nice, straight, simple line. And if you want to insert yourself on this bicycle and then think of the finish line as whatever is important to you. For some, it's they get to their retirement. For others, it's when they go on to greener pastures. Go on to the next life. So just put your finish line can be whatever it is that is important to you. And the reality is, of course, it's not a smooth line. There are just bumps along the ways. As I said earlier, I lean more towards the investment management side of our firm. So I throw some dates on there that correspond with significant downward movements in the stock market. But it doesn't have to be the stock market that throws you curveballs. And frankly, more times than not, it's something else. Anybody here retire or work for St. Clair's Hospital? Good. Last month I was here. Pretty widely known that they had troubles with their pension plan. Can you imagine retiring, thinking that you're going to get a couple $1,000s a month?
They defaulted on the pension.
Defaulted on their pension plan. It was not protected by St. Clair's. St. Clair's in Schenectady. So we had a couple here. She retired from there, and we had a little side conversation, and she was expecting $1,800 a month in retirement to supplement her Social Security, and it didn't happen. So that's an extreme case. It's a rare case, but things happen. It doesn't have to be just the stock market. Maybe you were counting on an inheritance. Okay, older parents kind of said to you, "Hey, you're gonna be good. We've got some money saved," and then they ran into some health challenges, and they had to spend that on their own health care, and you didn't get what you thought. Lots of different circumstances that there could be. So, bottom line is, in a perfect world, you wouldn't need us. Drew and I would be doing something else, right? You wouldn't need a team of advisors to help you navigate the real world. So this is true for both the accumulation phase, that is the phase in your life where you're saving money towards retirement, and or where most of you are tonight in what we call the distribution phase, and that's the returning of your monies to you in the most efficient way. And the real big bogeyman here is the tax man. We talk about taxes and tax-efficient investing and tax-efficient distribution more than anything else. It is by far the biggest hit. And again, we talk about 2022, S&P 500 was down 19%, the NASDAQ was down 33%. Well, most of you probably lose 25% on average every year to the IRS. We've got the proverbial bear market every single year due to taxes. So we're going to be talking about tax strategies here in a little bit here. Again, by a quick show of hands, how many people are covered by a traditional pension plan? Good old pensions. Okay, as you know, that number is going down. Okay, good for you. That's good. They are, not common. We don't offer one to ourselves or our employees. Sorry, Drew. We're proud of our profit sharing, but let me tell you, it does not replace a good old traditional pension. I've run the numbers, and I'm a business owner, just like lots of other businesses, and they are just wildly, wildly expensive, very difficult to fund. So they're going away, or fewer and fewer people have it. So the distribution from your various buckets becomes very, very important. So, the Secure Act 2.0, how that's going to impact you. Well, first and foremost, it's a massive bill. It was attached to the spending bill December 29th. They voted on it, and like every other major piece of legislation, our great politicians didn't read it. They don't. Literally, it's 350 pages, and it was just tacked on. It's been in the works for months and months. It was actually a surprise to us that it passed, okay, because they have been working on updating the first Secure Act from 2019 for a number of years. But the big ones are, probably the most for this crowd, is the RMD age is now age 73, okay? For my entire career, we used to use the age 70 and a half. The year in which now it's 73. The year in which you turn 73, you are mandated to take money out of an IRA account, 401k, 403b, whether you want to or not. Okay, it's an income grab. The only reason they did that is that money's been growing, tax deferred. There's no taxes while that money's accumulating in those accounts, and now the government wants to tax it. So it's treated as ordinary income. If you lean in real closely, I'll tell you the one secret to get around it. There is not. Okay? There is no magic wand. Okay, sorry. Okay, I don't have a secret handshake, secret sauce. No, there's no secret. Okay, it is treated as ordinary income. It's recalculated every single year. That's the required minimum distribution. The good news is it's now 73. It won't impact. It'll be for me. It'll be 75 because in the year 2033, it's going to go to 75. So you have to be born in 1960 or earlier, later rather. You have to be born in 60 or later. That age is going to 75. Now.
Move to Costa Rica and become a resident of Costa Rica.
You know, I'm going there next week. I'll just stay. That's perfect. Let's see. If you move to Costa Rica, gave up your citizenship in the United States, yeah, that might work. You'd have to get your money out of the States, though. That's the hard part. You know, I don't know how that works. There is actually one piece of advice. If you're charitably inclined, okay, you give money to charity, you can, up to $100,000 a year, give money from your IRA account directly to a charity, and it doesn't become income to you. So let's say you have a $500,000 401k, you're 73 years old, and that year the government tells you have to take out $22,000. And you normally give $4,000 or $5,000 to various causes. If you wrote checks from your IRA account, get your custodian to give you a checkbook, and you wrote those checks directly to the charity from your IRA, then you'd only have to claim, say, $18,000 of the $22,000 because you gave $4,000 away. That's the only thing I know of to get around that distribution. Other big provisions, I'll say there's probably over 100 law changes. Some impact you, many impact small businesses with the incentive to offer a 401k. There is incentive to add more money to the account if you're age 60 to 64. That's not in effect yet. It is a confusing bill because some things went into effect December 31st, 2022. Other things are phased in between now and the year 2025. So I have a packet that I study and read of over 100 different things, and you have to look very closely when does it go into effect. But one thing you hear about the press, maybe anyone have a 529 account for their children or grandchildren? Okay, so I have 3 teenagers, starting to do the college dance here with my junior. I've been, I did take my own medicine or take my own advice and started 529 accounts many, many years ago. I talk to parents all the time, some grandparents. The 529 plans are great vehicles to save for college, but I do hear, and I just heard this from a young couple recently, that they're hesitant because if the money's not used for college, then there's a penalty and the earnings become taxable. And they don't want to, they don't know if their child's going to go to college or not. So whether that's valid or not, that's not here nor there. It's what their opinion is. So I said, well, good news. With the Secure Act 2.0, there's now a provision that says that if the account's been over for 15 years, so you have a young grandchild who's 3, and at 25, they just didn't go the college route or trade school route, they just didn't do that, then you can roll $7,000 of that per year into a Roth IRA for that beneficiary. Okay, you can do that up to $35,000. So it's a little bit of an out if you're anxious about overfunding a 529 plan, which is very hard to do, to overfund a 529 plan. But as we talk about this with parents and grandparents, the jury's still out on that, whether or not the advice should be, hey, as a grandparent, maybe you want to overfund the 529 account by $15,000, $20,000, $35,000 because you could get that money into a Roth for a 20-year-old or a 21, 22-year-old and let that money grow tax-free for their entire lives. Pretty powerful, okay? So there's some catches. It's not perfect, but 529 to a Roth is a new Secure Act 2.0. Coming up next year, there were only a couple of people working here, so but if there was an employer match, that money has to go into the Roth portion. Some real weird things. We're still waiting for the IRS to clarify a couple things. It was a massive bill, and what happens with these massive bills, it gets rushed through, and then the people who actually practice this say, that actually doesn't work in the real world, and what about this? And they say, oh yeah, we didn't think about that. And they have to come through and amend it and or give clarification. So stay tuned. More of that coming up in the coming months.
What's the effective date for the RMD going to 73?
Now, it went into effect day one. So if you were 72 this year and you thought you had an RMD, you don't. You got a year. Yeah. So that went into effect immediately, January 1st. So that was cool. Okay. Okay, let's talk about who else has a question about the Secure Act 2.0. All right, let's keep going. All right, so we got all these different buckets of money. And this clearly is not inclusive. I haven't put up there health savings accounts. I didn't put a 529 up there, but I put, 6 of the big ones. And recently I bolded, or I guess I increased the font on the Roth IRA. Last year, I didn't do this last year, before the COVID hit, that was not bolded because Roths were popular, but not that, they were just like any other bucket. But I'll spend a lot, in a minute, I'm going to spend the majority of my time talking about the Roth IRA because the Secure Acts, the unofficial phrase or unofficial name of the Secure Acts are the Roth conversion bill. And I'll tell you why we say that. It's not me, it's the entire industry in a minute. But let's start over here. There was a few of you who were covered by a pension. You guys are all retired. So just ask you guys, when you retired, what was the big decision you had to make?
Health insurance.
Anything related to the pension? No? Survivor option?
Well, yeah,
Spouse, yeah. So there's pretty easy. Okay. Well, for some it's not. It's a mathematical question. So the thing I was referring to is if you're married and you take when you file for your pension, you have to elect a survivor option. Do you want to take more money every month and have 0% go to your spouse, so it dies when you die, or do you want 100% to go to your spouse, but because they're insuring 2 lives, then you get a reduced amount, 50%, 75%. There's a pop-up. It's a big decision, and the calculation where we help our clients with that decision is it's a holistic everything. Your situation is not what your brother-in-law did or what your neighbor did. It's unique to your family, and there's a method to the madness as far as how to make that calculation and what is right for that couple. If you're single, no decision. You take it, and when you die, the money stops. The important thing is it's irrevocable. Okay, you can't say, I took the 0% option because I'm a 65-year-old man and I'm going to live forever, and then you're 70 and you start to die and you're like, oh crap, my wife's really going to be out of luck here. That's not what I thought was going to play out. There's no do-overs, so it's really important. Social Security. Full disclosure, I am not the firm's Social Security expert. In fact, I'm not even close. Drew and Corey have me beat hands down. But I do know enough about Social Security to know that there are absolutely filing strategies that are better than others. And I cannot stand up here and say everyone should wait to 70. That's the maximum you can wait or should wait. If you don't take Social Security by 70, you're just giving your money to the government because there's no retroactive dollar. You shouldn't all take it at 62. You shouldn't all take it at 67. Again, that Social Security maximization or that Social Security audit, if you haven't taken it yet, call Corey. Really, he's the person at our firm who who knows it the best. And I've seen him try to argue people out of what their mind's made up. He's trying to show them. So we do talk to some people that are like, I'm taking it at 62. I don't care what you tell me. Your facts don't matter. My opinion is this. And okay, fine, that's fine. Yeah, it's a roll of the dice. When we talk about financial planning, we're going to ask you all these different questions, all these different data. And to create the perfect financial plan, we're going to ask you one question at the end. And if you tell us that answer, we'll create the perfect financial plan. And that question is, what month are you going to pass away? Right? I don't know if we could find out. I'm not sure I want to know.
Only the month, and what about the year?
Yeah, give us the year. We'll get close. Sure. We don't know that, right? So all this planning is based upon a series of assumptions. But with Social Security, there are definitely, especially if you're married, there are spousal strategies based on who made more money, how old you are, your health goes into it, family history, longevity. It does make a big difference. And if you have some of these other buckets of money, primarily a brokerage account is like a bank account on steroids. It could be individually owned. It could be a jointly owned. It's not an IRA. It's got any dollar amount in it. It's invested in stocks and bonds, maybe cash, CDs, whatever. If you have money in a brokerage account, this is probably the bucket of money that we can add a great deal of value or get the most creative in your 60s and early 70s, because with some tax knowledge, you can distribute this money very, very efficiently. In years like last year, if you're working with an advisor or you were doing it yourself, we hope you used last year's downturn to do some tax loss harvesting. There's nothing fun about seeing your portfolio down 15, 20, 25% like it was probably last year. However, it's lemons. You're given lemons. Making lemonade is making sure that in the middle of last year, you should have been harvesting some losses, i.e. selling one thing, buying something else to lock in those losses to offset future gains that are inevitably going to be, which will inevitably be there. So you can very efficiently take money out on a monthly basis. So if you're retired and you need $5,000 a month from your portfolios to supplement a pension and Social Security, if you have enough money in this bucket, you could delay Social Security, for example, take money out of there with almost no income tax. Worst case scenario, it'd be capital gains. If you're given the option, would you rather have capital gains or ordinary income?
Capital gains.
Always capital gains. They're always taxed at a lower rate. Okay, always. And if you can keep your joint adjusted gross income below $89,000, you have no capital gains. Okay, so again, knowing the tax brackets, married, filing jointly, single, whatever it is, knowing where those thresholds are, understanding how to maximize Social Security, but by taking money, robbing money from the brokerage account, letting Peter over here, this is Paul, that's Peter, let Peter grow Social Security by a guaranteed 8% between 67 and 70, that's often a very, very good strategy. Okay, so just an example of what you can do with Social Security. I've talked about the brokerage account. Capital gains are a great problem to have. I joke with my clients that my goal is to pass on to them, even if we're efficiently investing, if you get a capital gain bill every single year, God bless you, because you're making a lot of money. Okay, I've had clients yell at me because they got a big capital gain 2 years ago. I'm like, listen, man, you made 40%. You're killing me. Right? Yeah, there's times you have to make some changes. It's a good problem to have. However, tax loss harvesting should be part of your process every fall, every summer. Take a look. If something's down, you can sell it, buy something that's just like it or very similar. Avoid the wash sale rule and harvest that loss. Okay. The other nice thing, the tax implications, the return of your principal, the tax efficiency of brokerage account, very, very nice. Now, if you don't have much in the way of saved in a brokerage, chances are you've got some money in a traditional IRA or a 401k. The balances we're starting to see are very, very large. 20 years ago, we never saw $1 million in a 401k. They hadn't been around long enough, and you couldn't put that much money into it. This year, if you're over 50 or over, you can put $30,000 in your 401k. So you got a household that both are working, you could put $60K into a 401k, and that's before your company match. Okay, so we're starting to see big balances. It's not common, but we're starting to see balances on a regular basis in the 7 figures. And what that does is it does cause, again, this is a first world problem, it does cause large required minimum distributions. When you're 73 years old, chances are your pension's already been turned on if you have one. We know your Social Security's already been turned on because you can't wait past 70. Maybe you have some capital gains every year. You have some dividends and interest that you're earning, whatever your sources are. And then all of a sudden the government tells you got to start taking money out. It's taxed as ordinary income. It is not uncommon for us to do projections for our clients and show them that when they're 75, 78, 80, they will be in a higher tax bracket later in life than when they were working. And they say, how can that be? It's because your minimum distributions grow each year. Okay, the way the formula is calculated, most years, I should say most years. If the market value goes sideways or up a little bit, then your RMD each year will grow. It's just the way it's calculated. So great buckets to have money into, but inefficient on the way out. Okay, so before I continue on to the Roths and continue on, any questions about pensions, Social Security, or the brokerage account? Okay, all right. So let's talk about the traditional IRA, the 401k. So as a refresher, you put money into those buckets on a pre-tax basis. You deduct it off your W-2 or you deduct it off your taxes as you put the money in. As it comes out, it's treated as ordinary income with the thought that as you're working, you're in a higher tax bracket than when you will be when you're retirement. So you're putting in pre-tax dollars now, take it out later when you're not working at a lower tax bracket. That's the theory. That's what, and for a lot of people, that is the case. The question we get on a regular basis is, should we be putting money into our Roth bucket or our pre-tax bucket? That requires a little bit of analysis. So we'll ask you, what will be your other source of income? Do you have a pension? Yes or no? What are your Social Security projections? Okay. What are your IRA balances? With that information, we can project what your required minimum distributions. If we show that maybe you had an inheritance and it bumped that bucket up so that you have a lot of dividends. If we show you that you have higher tax bracket in your 70s and 80s than you do, say, in your early 60s, then you should put money into the Roth bucket. Okay? No deduction now, grows tax-free, but when it comes out tax-free. You want to be in a high tax bracket when you take money out of a Roth IRA. If it's flipped around and you're taking money out, or excuse me, you have W-2 wages or your income's high now and it's projected to be lower later on, then you should be doing pre-tax contributions and take money out of your Roth then, not later. Okay? Pretty straightforward, but you have to know how to do that calculation. And we used to do it longhand on legal pads. Now we have software that does it for us. Right? Now we need to know your information, but it does make the work much, much easier. So I mentioned I increased the font on the Roth, and the reason why is that Roth conversions have been become very, very popular. There's a technical difference here. There's Roth contributions. That's where you take money from your savings account and put money each year while you're working. That's $7,500 this year. Last year was $7,000. That's all you can contribute if you're working. If you're not working, you can't contribute. And if you made more than a couple hundred and something $1,000 as a joint couple, you couldn't contribute also. I'm not talking about contributions. What I'm talking about is conversions. A conversion is when you take money from one of these two pre-tax buckets and move it into the Roth. The downside, as I mentioned, is these buckets are growing tax deferred. You're eventually going to have to claim it as income. Your children and or heirs are going to have to claim it as income, whereas here they do not. So the IRS allows you to take money from these two buckets and convert it to the Roth. And once you do that, the money will grow tax-free the rest of your life, and your children and or beneficiaries can inherit that money and not have to claim a single dime. It's great.
Can you convert an inherited traditional IRA into a Roth?
Nope, sorry. Nope. So I omitted the big catch, right? Of course there's a catch, right? We would just all run out and just take all our traditional money and put it into Roth, and no one would have any money in traditional. The catch is, at the point that you do it, it's taxable. Okay? So, again, we have, this is a snapshot of a real client. This is our software package. This is the taxes. This is not tax bracket. This is the taxes that they're projected to be paying each year. Okay? And this is a snapshot. If you scroll down, it would show you what their effective tax bracket is going to be. So they're paying, they make a couple $100,000 a year from various sources. So they're paying 40 grand in taxes from a couple different sources. They're going to retire, and then there's a period of years here where they're basically in the 0% tax bracket because they're living off of savings. They would be they would benefit a lot by doing some Roth conversions in these years, because we know that when they turn 72 and future on, their income taxes are very, very high, very much higher than here. Having these big dips in peaks and mountains is not efficient. It's more efficient to bring some of those future tax dollars forward and pay less overall than you would in that scenario. So when you take money from one of these buckets and convert it to Roth or IRA, you want to do that in a year where you think you're going to be in the lowest tax bracket. Don't do them in January or February because you may have surprise income or something may happen. Do them in the fall. November, December are the time when we do these conversions for our clients. And the question of, well, how much should we convert comes back to what are your sources of income? You typically, there's tiers of income. 0 to 89,000, you're in the 12% effective tax bracket. 89 to 180 something, you're in the 22. Then it goes to 24. Then it jumps up to 32 again. So you kind of want to avoid the big jumps. Okay, how much you should do? If you are, what's the word? If you are not charitably inclined, if you're altruistic to your children or nieces or nephews, Roths are great. They inherit that money tax-free. Okay, where when they inherit these monies, they have to claim it as income. And the reason why the Secure Act back in 2019 really made Roth conversions more popular is that in the old days, i.e. 2019 and before, if I inherited an IRA from my mother, then I could take the money out over my life expectancy. 52, I don't know, I think the life expectancy tables say I probably live 35 years. I don't know, but something like that. So I would have been able to take out 1/35 of the account each year and distribute to myself and paid very little income tax. Now, when you inherit an IRA, if someone died after 2019, the non-spouse beneficiary has to take it out within 10 years. The account has to be depleted within 10 years. So if you had, $500,000-$700,000 account that you inherited, cool. But now you've got to take $70,000 out each year plus growth. That's probably going to throw you into another tax bracket. It's much, much less efficient because the condensing of the taxes. So the government gave us age 72, then they bumped to 73. They took away the ability to stretch it out. So that makes the analysis on the Roth conversion that much, much more powerful. Now, if you are 75 years old, your pensions are turned on, your Social Securities are turned on, your dividends are basically the same, you're getting your RMDs, your tax brackets probably aren't going to move that much. If you really want to do it for the kids or grandkids, then maybe a small Roth conversion can make sense. But, it's usually done in these tax years, and that's usually in the mid-60s. Not for everybody. It's a generality. There's a generalism here. So I'll just say that that 60 to 65, 67, 68, those are the years that's the most efficient. Okay? Any questions about the Roth conversion or the concept? Yes, sir?
Is there a termination of when you have to take the money out of a Roth for and not for myself, but for my descendant or.
They have to take the money out within 10 years also, so they can't just leave it there forever and let it grow tax-free, but it's not taxable to them.
Right, but there is still a 10-year.
Yeah, and they got rid of that too. That used to be a multi-generational benefit also. You could, grandparents used to name their grandkids, little kids. They could stretch out their whole life and, have 50 years worth of growth inside that Roth, which was pretty nice. They got away with that too. So they gave some stuff, but they took more away than, taxes. There's a deficit they got to pay for. Stamps are going up too. Yeah. Any other questions about the distributions? The fancy phrase is the sequence of withdrawals, and a lot of times we talk to our clients about their rate of return. Other times we talk to them about this strategy, and we have software that will show you if you employ these strategies, over your 20-year life expectancy, your 30 or 40 life expectancy, it's tens of thousands, if not hundreds of thousands of dollars difference in taxes paid, less taxes paid, and or money that your family, i.e. your descendants, keep. It's very, very powerful. And it's just having that knowledge of how much, when to do the conversions and how much. And one other thing I'll mention, if you are a do-it-yourself and you're going to rush out and do a Roth conversion, there are some unintended consequences that you have to be aware of. Medicare premiums are based on your income, and it's a 2-year look back. So if it made sense for you to do a $200,000 Roth conversion 1 year, know that your Medicare premiums 2 years later are going to go higher. It's probably still worth it, okay? But you can go from paying $162 a month in Medicare to $458, or I think the maximum is like over $500 per spouse, because what you pay in Medicare premiums is based upon your adjusted gross income each year. So if all of a sudden you had a couple years of spikes in that adjusted gross income because you did Roth conversions, know that increase should go into your calculation of how much and does it make it worthwhile. So there's tax brackets, and then there's Medicare income brackets, and they're different. And if you are aware of what they are, you can stay below certain thresholds, because unlike taxes, which are graduated, the Medicare is a cliff. If you go $1 over, you pay the higher premium all year long. It will reset the next year, but it can be costly. Just be aware of that. All right. And as I said, a lot of times it's not about you. It's about the grandkids and the children and the grandchildren. It's multi-generational planning. How much to spend? That goes back to the philosophy of do you want your last check to bounce to the funeral parlor, or do you want a large legacy? And that's the question we talk about with our clients all the time. We have some clients who may have $1 million today and they want to leave $3 million to the kids, or they might have $3 million now and they don't want to leave a penny. And again, when are you going to pass away? We don't know. So that's art. There's some science to it, but there's also some art there. But again, it goes into that planning as we talk about here. All right. Talked about that. All right. So any other, before I'm going to do like a 180, 90-degree turn to finish up here on portfolio management concepts here. Any questions before I leave that topic? All right, moving on. So, which way are interest rates going? 6 months ago, I would agree with you. I don't know. The Federal Reserve is probably going to raise rates some more, right? Now, that does not mean that the 10-year Treasury has to rise. So, we had this question today, or we had this conversation today. We meet formally to talk about portfolio management twice a week. Tuesdays and Friday mornings, we get together, the four of us at the office, to talk about strategy and changes that we want, implementation strategies to the portfolios. And we laid out a matrix of different scenarios here, and frankly, no one knows. Chances are the Fed will raise rates some more. Inflation's still strong. Last Friday's jobs report came in wildly high. Job creation's through the roof. Good news is bad news. Okay, this is confounding to the average investor. How can you have good news? There's lots of jobs, or Or good news is there's low unemployment and the stock market goes down. It's like, what's that about? That's good news. We want interest rates to stop going up. And the reason why interest rates would stop going up is the Federal Reserve would see that our economy was slowing, so job creation would be going down, unemployment would be rising, inflation would be going down, food prices would be going down. And until they see these signals, they're going to be inclined to continue to raise rates. And at a certain point, if they raise rates too much, the chance of a recession grows exponentially. And if it's too much of a recession, then we have the opposite problem. Then they have to be charged with growing the economy. So it's a fine line. It's a very difficult process, but chances are interest rates are going to go a little bit higher, and when they pivot and start to go back down is not known, okay? But it's very important to have an idea of when that starts to happen, because the bond market is directly tied to interest rates. It's an inverse relationship. So if you're a fixed income investor, is now the time to be extending the maturity with higher interest rates? Should you be locking these in for a longer period of time? Or do you think interest rates are going to continue to go higher, so you want to wait? Because if interest rates stop going up here in the near future and start to go back down, to be able to lock in a 4 or 5, 6% coupon may only be a short window. Okay, the interest rates might start going back down here by the end of the year if the Federal Reserve stops raising rates. And if we go into a recession, then what they're going to have to do is they're going to have to start lowering rates again. Okay, so for the first time in many years, you can get CDs, certificates of deposit, in the 4s, almost 5. Money market rates are in the 4s. A year ago they were paying point nothing. Literally point something. It was awful. And bam, Federal Reserve raises rates 4 or 5 times. Now we are back to not historically normal, but you can actually make a little bit of money on your cash now. So all of these, whether it's the global economy, which way is the U.S. dollar going, whose economy is stronger, all these things go into making decisions as far as what you should own in your portfolio. The biggest mistake we see investors make is they take a static buy and hold approach, which we do not agree with. We are not day traders. We're not even traders. We are investors like you are, okay? But we take an approach where you shouldn't just drink the Wall Street Kool-Aid, and it's Wall Street Kool-Aid of buy and hold. A lot of times you'll say, you have a 401k, or you have some money in a handful of stocks and or mutual funds, ETFs maybe, and you just say, you know what, I keep hearing I got to buy and hold, set it and forget it, and everything's going to be okay. Very few things in life, including investing, you can just ignore and expect 20 to 30 years later to be okay. Your marriage doesn't work that way. Your health doesn't work that way. You got to work at it, okay? Now, if you work at it too much, you work out too much, or, whatever, it can be too much, okay? So there has to be a balance. However, or along those lines, okay, buy and hold is the biggest mistake. And there is a big disconnect between you and Wall Street, because the big Wall Street firms and really the mutual fund companies don't want you to ever sell. Because if you go to cash or you sell their funds, they lose revenue. Okay, so again, understand how these firms are making money, and you'll see the conflicts. With regards to mutual funds, I'm not talking about product tonight. I haven't talked about individual stocks that we want to own, or the benefits of an ETF versus a mutual fund, or what ETFs you should own, or which mutual fund sector you should be in. That's not tonight's conversation. That's a conversation for the office. However, if you still are an owner of actively managed mutual funds inside of a taxable account, shame on you, shame on your advisor. Tax-efficient index/ETFs have been around for decades now, and there's absolutely no reason to be getting unnecessary capital gains distributed to you in December typically. It's an age of dinosaurs. Inside IRAs, 401ks, that doesn't matter because that doesn't apply. But if you're still holding actively managed equity funds inside a brokerage account that's taxable, you're paying a lot of unnecessary taxes, and it is detrimental to your wealth. That's as clear as I can be about that. But a more active management style, okay, where you're paying attention to the various asset classes and, more importantly, the sectors, very, very important, very, very, very additive to your net worth. Now, why is it so hard to invest money? It's an emotional subject. Money is emotional. And we know for a fact that if I take $1 from you versus give you $1, you will feel that dollar loss 2 times more than by winning $1. If we brain map, or the heat map of your brain, and scientists have done this, we have an aversion to loss. It's probably from our prehistoric days, like just losing is bad. So we fear losses and we make irrational decisions when things are down here and frankly up here. So part of our job is to keep our clients off the emotional roller coaster, okay? Anyone want to, I don't know, we've had a nice little rally here this month, or this year actually. The Nasdaq's up 11%, S&P's up over 6.5%, 7%. We're having a good year this month. I mean, that's decent numbers for like a whole year. Now, we're coming off a very low number from last September, so it doesn't feel that good, but the markets have actually done pretty well. Anybody have an emotion that they feel right now? You want to share? No, I don't. Not. Hopefully, you're not feeling defeated. Last September, you probably did, right? Little different. Anybody feeling euphoric? Unless you had all your money in oil, you're probably not feeling euphoric. Okay. Every asset class besides oil went down last year, including gold. It was a challenging year. You know, we are trained to understand things that have low correlation or negative correlation. These are not laws of physics or laws of science that have to happen. We work in areas of rules of thumb, and a lot of things that traditionally do work didn't work last year. A little bit like 08. Bonds were down 13%, if not more. Gold was down. Cryptocurrency was down. I'm not an investor or fan, but my point being is that almost all sectors and asset classes were down last year with the exception of oil. So a lot of money leaves the market. A lot of money comes into the market, obviously at the wrong time. And what I like about this year's market is we still have a heavy dose of skepticism. That fear has to be there for stock prices to go higher. And when we start getting euphoria and you start talking to the taxi driver and he or she is giving you investment advice and how they're making all this money, that's usually a really, really bad time to be throwing money at the market. It takes a lot of discipline to be adding money to the market when this is happening, but obviously it's cliche and it sounds easy, but working with professionals who can remove that emotion from the equation does absolutely, over time, benefit you. In all things other than investing, going by your gut is the way to go, especially with interpersonal relationship. You know, our gut, our intuition, it really does work. Unfortunately, the emotion it's the opposite. You really should do the opposite of what your gut tells you when it comes to investing, and time again that is proven by statistics. So we take, and again, I'm just going to touch upon this here because I want to wrap things up here in a few minutes. But we are a big advocate of sector rotation, understanding if you look at the 135 different sectors and asset classes that exist, you look at only on a weekly basis, you do see trends happening. It is nearly impossible to time the market. I do not advocate timing the market because you'll usually get it wrong, okay? But what I do advocate is having a strategy to rotate into different asset classes. For the first time in years, we've recently bought some international stocks. They have not done well for 12 years. I'll call it 11 and a half years. The first Arab uprising of 2011, spring of 2011, and that was a new phrase that we all learned. And since that period of time, the US dollar has been going higher and international stocks did very poorly relative to the US. Well, guess what happened a few months ago? The US dollar started to weaken and international stocks started to do well relative to the United States, and we started taking a position. And the same can be done if you measure this supply and demand with a little bit of data and a little bit of discipline, and this is what we bring to the equation on the portfolio management side. So I have an outdated picture of an NFL coach. Okay, he's long gone. Okay, but at the time, and I don't care who that picture is, the person is, it's what he's holding that's important. Does anybody have a written investment process? Roger, do you? Is it written? Roger's not a client, but we know each other. Yeah, we've talked in the past. Do you have a process that's written?
Yeah.
Yeah. Okay. Anybody else? Most people don't. Okay. But we're an advocate of it. Okay. And we have one. And the reason why you want to have a written process is because in the heat of the game, okay, football's easy. You're either on offense or you're on defense. And it's very clearly delineated, right? There's no gray area. Maybe during a fumble, you can't tell who's doing it, but who's got the ball, but that's for a split second. In my world, there are clearly times when we're on offense, and there's clearly times when you're playing defense. Last year, by February, March, it was clear defense ruled the world, or ruled the year. This year, we're playing offense, okay? And a lot of indicators have gone from negative to positive here in the last few months. The market bottomed back in September 30th, October 14th, depending on the index that you're following. And we're up double digits across the board in all the major indexes in the United States. So we're back on offense. So you have plays or strategies that you employ, whether the offense has the ball, field, or not. And there's times when, again, last year, you want to be quick to sell the losers, harvest the losses, play defense, go to cash, short-term bonds, anti-correlated assets. And other times when it's like, okay, now it's okay to put a little bit of money back to work because clearly offense has the ball. So you have a combination of growing the money when you're trying to grow the money, protect the money, and everybody that we talk to has a different objective with their money. Some people might be in their 80s and they still want to maximize their growth and it's stocks for the long term. And other times it's people want to be like, we've got enough. We're not looking to hit a home run every year. We just want to protect what we have. It depends on the mindset. And other people, they need to grow their money because as retirees, inflation is a fantastic risk. Okay? Think back to your own parents when they retired in the 70s or 80s and they had a pension worth $400 from the telephone company, and you look back like, how did they ever retire on $400 a month, right? Well, they also bought a house for $12,000, right? And maybe you bought a house for $50,000, right? Tell me your first name. Larry. Do you remember how much did you pay for your first home? You remember?
Yes.
Ballpark.
$70,000.
$70,000. Do you remember the year?
1981.
Okay. Did your parents think you were insane?
Yes, of course.
Of course, right? Just Larry, we paid $12,000. Why would you ever pay $70,000, right? And your children probably live in houses that are worth hundreds of thousands of dollars.
That's true.
Of course, right? Inflation. So you gotta keep pace with inflation. You gotta grow your money. All right. Bottom line here. All right. Coming down the home stretch. A couple more minutes here. So the reality is there's bumps along the road. Our hope, our job, our firm hopefully can provide a lifeline, a zip line, a bridge, a rowboat, provide the umbrella to help those navigate those ups and downs. But it's also during the good times to optimize the plan. And clearly investing, financial planning, it's a series of very complex subjects. Too complex. I'm scratching the surface tonight, but trying to touch upon a few things of how we help our clients. And, this is a process. Tonight was an introduction to me and part of my team and some of the things we did. If what I've said tonight is, piquing your interest and you want to have a further conversation, it's a multiple step approach. The next step is to get together, typically in the office. Everyone here is local, obviously. We do have clients nationwide. Zoom is a great thing to be able to work with those people. But if you're local, our office is right downtown. If you know where FedEx is, we're directly above FedEx on the corner of Congress and Broadway. The next step is, we call it step 2, that's where you kind of, you're not going to ask very, very personal questions here. Okay, so we're going to be able to get a chance of what you're trying to accomplish, and then from there, the third step is where we come back and say, okay, here are the things that we think you should implement, and how we help specifically give you all that information. I did mention, I don't think I did. We are what are called fee-based advisors. We don't work on commissions. There are two ways that we get paid. It's important to know. Obviously, I'm a big fan of transparency. Basically, we charge two ways. One is if you're asking us to manage your money, it's a percentage of the account value. There's a very famous investment firm that has commercials all the time. We make more money when you do, unless it's Fisher, right? There's 17,000 firms like mine. We're all the same. Okay, we all bill the same way. So if you do better, we do better. If you do worse, we do worse. So we want you to grow your money. That's on the asset management side. Some clients do come to us on an annual basis. They are do-it-yourself investors. They have their own process. They like doing it, but they're not sure about the financial planning, and they want a financial plan. And that's where we come up with a dollar figure, whether it's $2,500 or $3,000, depending on the complexity of the situation. But that's the number I would give you ahead of time. And again, we lay this all out in the meeting at our office, so you are able to make an educated decision and not have any surprises, because everything is laid out as far as what we're going to do, what we expect of you, and what the financial relationship is between the two firms. It is a process. It's not about product. You can overlay actively managed mutual funds or ETFs or individual securities, bonds, stocks, mutual funds, whatever it is, CDs. It's process, not product. I've talked about some of this stuff already. We do, try to do right by our clients. And I stole this from someplace I found on the internet. Some other things that a financial advisory firm brings to the table. Organization. Sometimes it's just, clients will come in, they have got 14 different accounts at 14 different custodians, and I say, how do you know what your rate of return is or where everything is? And they go, we don't know. Well, there's software out there now that aggregates that data. There should be no doubt. If you want to know what your net worth is, what your plan is, what your rate of return is, you should be able to log onto a website and know to the 10th decimal place or to the penny what that is, if that's important to you. The technology has existed for many years. That should not be a mystery to you. Accountability. Sometimes it's like if you want to retire and have this certain lifestyle, you need to save more money. Or you can take more money out of your accounts unless you want to leave X number of dollars to your children or heirs, then you can actually afford to take more money. Objectivity. A lot of this on the investment side. That objectivity helps to avoid the emotionality of investing. We've been doing this for a long time. Everyone is unique, but there's times I get surprised. That's a certain situation, but we've seen a lot, and I've seen, I'm not sure thousands, but definitely high hundreds of people go from making that transition from working to retiring. And I think it's a top 5 life event. Maybe marriage and children, loss of a loved one. There's some really big life moments, but going from working full time to not working at all, it's a big one. And a lot of people handle it very well, and some people don't handle it well at all. So, helping you make those life transitions is an important part of what we do. And then it's the education side, not just nights like this or podcasts that we do or recordings that we make and put on our website. It's, providing you the level of education that you want. We have a lot of engineers, and they want to know the alpha of the portfolio, right? They want the details, okay? And we've got clients who say, we don't even look, or I don't care. You're doing it. That's what we're paying you for. And everyone in between, right? So we learn what your objectives are and what your level of specificity, if that's a word, is on the knowledge side, and work together. So, and it is a partnership. I'm going to stick around for a couple minutes to answer any specific questions that you might have. If you do have a couple of questions, you can write them on the back of that feedback form, And again, the last thing I'll ask for you is just take a moment to fill out that feedback form. You can hand it to Drew or I, or just leave it at your place and we'll collect them when we're done. And thank you for joining us.
Thank you.